Hello, hi guys, welcome back and thank you for watching another episode with Lighthouse Academy. Alright, I hope you will like this video where we dive deeper and continue to learn about some of the techniques and ways we can use on our investing journey. Alright, without further ado, let's get started. Alright, so a quick one, if you are new to this channel, you haven't subscribed to this channel, please subscribe to our YouTube channel by clicking on the subscribe button. Alright, of course, also click on the bell button beside it so you will be notified of the next up and coming training video in the future, right? So that you can continue to learn new things, okay, when it comes to investing week after week, right? So a quick disclaimer: if this is the first time you're watching this video, right, please pause the video and read on the disclaimer. Mainly just going to say that whatever we share in this video is just for educational purposes. We are not here to do any buying or sell recommendation. Alright, okay, so if you have not watched last week's video, alright, this is a continuation more or less from last week, alright, because in last week we talked about technical analysis, mainly on how to actually draw support and resistance using horizontal lines and diagonal, or aka we know as the trend line. Alright, I did briefly touch on the moving averages, which is a dynamic support and resistance, and we're going to cover a little bit more in depth in this video. Alright, let's get started. Okay, so the first thing to find out is what is moving averages. Alright, moving averages is basically one of the indicators that is used within the technical analysis family. Alright, and this is help to actually smoothen out the price action by filtering out of the noise on a short-term basis. Alright, so if you look at this, okay, basically what it means, this blue line actually represents the 20-period moving averages. Okay, so in a daily basis, we can't really control how much the price will go up or go down. But because sometimes price might like this suddenly spike up in a day because of the news or a sudden movement or sudden release of economical news, things like that. Or it might just suddenly spike down because some random speculation. Alright, so a moving averages is here to actually help you smooth out the price based on a certain average over a certain period of time that you indicated. Alright, but do things to take note. Moving averages can help to use to actually identify trend, but they are actually a lagging indicator. Okay, basically what that means is moving averages every point of the day will start to form. Okay, will only continue when the market close with certain data is out. So the action has to take first, the price has to be recorded first before the moving averages can be plotted. Alright, so there's always a delay. Alright, so if you're using it as an indicators to actually do or rather use it as a forward indicators, alright, sometimes it may not be as accurate because it needs something to happen first before before it actually show you an indication, right? So it may not be as helpful or as useful as a leading strategy for you. Alright, so what are the two common types of moving averages that are usually used by investors and traders around the world? Alright, the first one will be the most simple one, with a simple moving averages. Basically, it takes a simple average over a certain period of time that you indicated. Alright. Otherwise, the next one will be exponential moving averages, in short EMA. Actually, this is something similar to the SMA. It's just that it gives a higher weightage on the more recent price action per se. Okay, so the periods that I mentioned earlier, it really depends on you how you want to use it. There are generally quite a number of periods that can be stated, but the more common one will be these four, which is the 50 days period, 100 day, 150 and 200 days period. And they are generally, the smaller the numbers are generally using for shorter term, all the way to the larger numbers that are the longer term. Alright, the key two most common indicators that are used worldwide are the 50 days moving period and the 200 days moving period. And most of the investors or even the normal day traders, they actually use it 50 days and 200 days as a guideline. Right? Okay, so what are the two ways you can use, okay, for moving averages? The first one, definitely you can use it to identify a trend. Alright, and the second thing will be used for support, as a dynamic support and resistance. So if you can recall earlier in the previous video, right, we tend to actually draw our support and resistance based on either a horizontal line based on the price itself, or we draw a diagonal or rather a trend line to form it. But sometimes drawing a line can be very subjective. Right? It depends how you draw it, because all of us see lines and see points at different ways and patterns. We might draw it differently from you and even the same person next beside me if we are looking at the same chart. right? So moving averages help you to come in, use it as a dynamic support and resistance because you don't have to draw it. The line formed by itself based on the data was given as a stated period, right? It formed this line by itself and use it as a support and resistance. Right, so how do you actually use moving averages to identify trend? Right, so this is an example. Moving averages actually on uptrend, right, and moving averages using as to identify as a downtrend. So as you can see, how do we know whether is it uptrend or downtrend? Very simple. Alright, if you're looking at the 50 days that is above the 200 days and both of them are sloping up or pointing up, you know that the stock is actually on uptrend. Vice versa, if you see the 50 days is below the 200 days because the short term is below the long term and both lines are sloping down and the price are below the line, you know that okay, currently this stock or ETF is actually on a downtrend. Simple. Alright, the next thing we'll know that we actually use moving averages as a dynamic support and resistance. Alright, so if you're looking at the uptrend, on the uptrend, you realize that price tend to bounce off this support and this moving averages using it as a form of support level. Right, so you can see that at this point, alright, it uses bounces off the 200, bounces off the 200. On the shorter term, it's bounces off the 50, 50, 50. If anything major happen, it bounces off the 200. Right, and here actually it broke the 200. Right, so if you are as an investor, if you are looking to buy, looking for entry to enter, right, you want to take note at such points that is bouncing off the 50 or even the 200 moving averages. This tells you sign that during this price action in this area, right, it is supported as a support level. This could be a good entry point for you to enter. Right. Likewise, for downtrend, you realize the price actually get lower and lower. Okay, once it hit a certain level, in this case, it hit the 50 moving average, it tend to go down again. You hit it, right? It doesn't stay, and it keep going down. It won't really break through and go up. So you can see that these 50-day moving averages act as a form of resistance on these downtrend stocks. All right. So a quick one to remember. Okay, so if you are looking at uptrending stock, support, the moving averages will act as a support. If you are looking at downtrend stock, right, the moving averages will act as a resistance. Okay, so when does a moving averages will not work? All right. Okay, the first thing is when the prices are going sideways, and number two, the prices actually don't respect the moving averages. Right. So as you can see here, when the price starts to consolidate sideways, the range of the price is generally very, very narrow. All right. So in that case, the moving average will take an average over the last period in terms of days or months, right? You realize that actually price action will just go up and down, and price will hit up, hit down, and just cut across the moving averages. All right. Another way that moving averages doesn't work is in some of the chart or some of the stocks, they don't respect the moving averages at all. So when you look at the chart, the moving averages tend to cut across all the price point, right? It doesn't form a trend like this or uptrend like this. It just cut across throughout the whole chart. That's where you know that actually this kind of stocks or ETF, actually the price action doesn't respect the moving averages. So these are the stocks, if you want to enter, you will not want to use moving averages as an indicator or a reference for you to find entry and exit point. Alright, okay, so that's all. So a quick summary about moving averages. So in general, there's only two kinds of moving averages that most people use: the simple moving average and the exponential moving average. And the period generally we look at is 50, 100, 150, and 200-day period. The most common one that we use is 50 and 200. Of course, there are smaller numbers where day traders use. If you are into day trading, please do your research and consult and find which are the moving averages on a smaller period of time actually work best for you in terms of day trading, right? Okay, if not, just stick to the 50 and 200. If you're an investor, that is pretty good enough. All right. So when do we use it? Okay, moving averages, we actually use it in the form of actually identify the trend, where the 50 is above the 200 is forming it an uptrend, and the 50 is below the 200 actually forming it a downtrend. All right. Of course, it can be used as a dynamic support and resistance. Alright, when it's on the uptrend, we use it as a support. When it's downtrend, we use the moving averages as a resistance. So you need to see when a price bounce off which line to tell you that that particular moving averages is respected and it creates a strong support or resistance level for that stock itself at that point of time. Alright, so when does moving averages will not work? Like mentioned earlier, when price actually moving sideways or price doesn't respect moving averages, those are the time when moving averages doesn't work on that kind of stocks or ETF or chart, right? You can just totally skip it. Find something else that will actually help you to find a good, better entry or exit point. Alright, okay, so with that, I hope you like this video. I hope this is useful. Please try and test it out on a demo account to see whether it works over a certain period of time, or back test it to see whether it suits your investing style. If it's not, you can actually just ignore about this moving averages for now. Once you get more proficient, you actually can go more in depth into this or apply it, implement it on your trading style. If not, you can just stick to what was actually mentioned on the previous video about drawing your horizontal and diagonal support and resistance. That is fairly good enough. Alright, okay, so thank you. I hope you like this video. If you like this video, please comment in the comment section anything you want me to cover. How do you find this video? And if you really like it, please give a thumbs up so that I know that you like this video. I will continue to do more trading series like this, right? It helps me keep me motivated and ongoing. If you find this trading series or this video particularly useful to any of your friends who are new to start learning about investing, please feel free to forward this free video for them to actually look through, read through, so that they know what it is going about, and then they actually start dabbling onto investing itself. Alright, okay, once again, thank you very much. I wish you have a good week ahead, good weekend, and I will see you in the next video. Bye bye.